India's corporate earnings are expanding. Economic growth metrics remain robust. Yet, the Nifty 50 index is mathematically locked in place. Take the trading session on May 20, 2026. Despite a strong fundamental backdrop from Q4 earnings, the index barely moved, suffocating within a tight 350-point trading range. This grid tracks the Nifty 50's internal breadth. While the index closed nearly flat, the surface stability hides structural weakness. Out of 50 constituent stocks, 29 of them flip red. The broad market is declining. A few heavyweights are just masking the retreat. Technical compression has effectively trapped institutional capital within pricing boundaries dictated by quantifiable mathematical forces. Three distinct pillars are enforcing this compression: aggressive options market mechanics, exogenous macroeconomic headwinds, and a massive impending liquidity drain from the primary market. In an environment defined by strict parameters, relying on broad directional momentum will fail. To survive a compressed index, we have to map the exact forces organizing this institutional capital strike. Looking at the Nifty's daily candlestick chart, we can map the absolute ceiling of the current structure. At exactly 23,800, sellers emerge. We see clear intraday rejections at this supply zone for 4 consecutive sessions. Beneath that ceiling lies the floor. Ahead of the May 21 weekly options expiry, the max pain metric sits rigidly at 23,500. This marks the strike price where option buyers lose the most money, and option writers maximize their collected premiums. Option writers have deployed massive capital concentrating put positions in the 23,300 to 23,400 range. With the index hovering near 23,618, this concentration creates an artificial gravitational pull, dragging the price downward to protect institutional premiums. Early in May, the put-call ratio collapsed to a panic level of 0.57. Today, it has neutralized to 0.9435. That specific ratio confirms the extreme institutional hedging from earlier in the month has cleared. But crucially, it has been replaced by balanced positioning, not directional greed. We see the same pattern in the India VIX, which dropped to 18.68. A declining fear gauge proves that panic is subsiding, but in a mathematically compressed market, a lack of fear does not automatically equal a bullish breakout. The derivatives architecture is functioning exactly as designed. Institutional writers are pinning the index in a narrow horizontal channel, weaponizing theta decay to bleed premium from retail buyers. Even if local options writers allowed a breakout, the market faces a primary exogenous constraint: United States monetary policy. The latest Federal Open Market Committee minutes confirm a deeply hawkish stance. With 4 active dissents against any easing bias, the probability of a June rate cut has effectively reached 0. When the Federal Reserve holds rates high, the US dollar strengthens. That strength operates as a vacuum, pulling mobile capital out of emerging markets. We see the immediate mechanical consequence in the currency markets, where the Indian Rupee fell to a record low of 96.2 against the dollar. That currency weakness compounds the secondary macro shock, Brent crude oil surging past $110 per barrel. Persistent geopolitical friction between the United States and Iran has embedded a heavy militarized risk premium into the current price of crude, moving benchmarks far beyond simple demand-supply metrics. Donald Trump's recent statements pausing proposed military strikes offered a brief catalyst for relief, pulling crude down slightly, but the baseline price remains heavily elevated. A 96.2 rupee combined with $110 crude acts as a heavy tax on domestic corporate margins. This dynamic specifically degrades the balance sheets of PSU banks, which rely on stable credit environments. The combined gravity of a hawkish Federal Reserve and an expensive global energy market makes a sustainable, broad market equity rally mathematically untenable right now. Capital isn't completely evaporating. It is executing algorithmic sectoral rotation. Quantitative funds are rapidly shifting allocations to survive the depreciating currency. This explains why IT stalwarts like Infosys and TCS are actively surging while the broader index stalls. Because they are net dollar earners, a weakening rupee directly inflates their export revenues. Conversely, PSU banks are facing aggressive selling. Structural credit quality concerns make them highly vulnerable to the exact hawkish macro conditions currently in play. Outside of sector rotation, capital is hunting for idiosyncratic catalysts that bypass macro trends entirely. The Adani Group provides the clearest example. Following a $275 million U.S. Treasury settlement and the withdrawal of Department of Justice charges, the heavy risk discount applied to the conglomerate was instantly removed, triggering a decoupled rally. When the primary index is compressed, capital flows exclusively toward extreme defensive posturing or highly localized, event-driven narratives. There is one final structural constraint actively capping the secondary market, and it sits entirely off the main exchange. This chart compares average daily institutional trading volume against the primary market pipeline. There is currently 3 lakh crore rupees, roughly $36 billion, waiting for regulatory clearance to go public. The largest component of this liquidity drain is the impending Reliance Jio mega issue, projected as an offer for sale of around 37,500 crore rupees, or $4 billion. With Jio seeking a valuation between $120 and $170 billion, institutions must hoarding massive reserves of cash simply to secure their required allocations. Add in the imminent public offerings from quick commerce Septo and the National Stock Exchange itself, and the scope of the capital absorption becomes clear. Institutional investors refuse to push the Nifty past 23,800 because deploying capital into a fully priced secondary market destroys the dry powder they need for these generational primary market allocations. This 3D schematic illustrates the exact mechanics of the stall. The price is trapped between strict options barriers, squeezed horizontally by global macro headwinds, and drained from the bottom by the IPO pipeline. The parameters for the May 20 session are mathematically defined. A close below the bear pivot at 23,580 confirms downward pressure. A close above 23,650 shows recovery momentum, but 23,800 remains the absolute ceiling. With the May 21 weekly options expiry looming, holding directional positions overnight carries asymmetric risk. Small index moves will trigger aggressive gamma acceleration. The immediate playbook requires discipline. Respect the 23,500 max pain floor, harvest profits early at resistance, and maintain overweight positions in dollar-earning IT and defensive pharma sectors until the macro pressures ease. Simple chart patterns fail in a constrained environment.